Hi, I'm Andrew Berman, managing partner here at Barrier Life. So I wanted to just hop on really quick because I have a lot of people asking me about pension max or pension maximization. And it's interesting because even the CPAs and people who are not fans of whole life or permanent life insurance, they all seem to know about pension max, and they understand actually that the importance of using a permanent insurance solution to be able to achieve pension max. So listen, pensions are great. Obviously, not as many companies offer pensions as they used to. Used to be basically, you worked to you're 65, and at 65 you got a gold watch and a pension, and you lived on that for 10 years plus the equity in your home, and then you kind of sailed off into the horizon. Today, vastly different. Obviously, not many of us have pensions, and also obviously we're living longer than 10 lives, 10 years in retirement. But pensions are great if you have one. It's an amazing thing. They say actually people that are born, or the people that have lifetime income, live longer lifetimes than their socioeconomic equivalent when they don't have lifetime income. Pension is a lifetime income. Guaranteed income annuities are also lifetime income. But so for the pension, when it comes time to turn on the income, you have a few different choices, but we're going to simplify it here, and let's just break it down to basically two choices. There's variations of these two choices, but it's your life or your life plus your spouse's life. So those are your two options that you have. You could turn it on so the income is just going to last your life, or it's going to also last your life plus the life of your spouse. So I love my wife and I want to do anything for her. Seems to me the logical solution would be to take the option where my wife is going to be protected. And this is the mistake that we've seen many people make before. So let's just say, to work with the easy numbers, your pension, maximum pension, max pension would be $4,000 a month. If you have that where it is also going to go for your spouse's life, so continue the payments after you decease and continue for your spouse's life, instead of getting paid $4,000, get a little bit of a haircut, and I'm going to go down, let's say $3,000. Again, just working with easy numbers here. So what we do in the pension maximization is a pretty simple solution. We just get a small little insurance policy somewhere, in between the $1,000, the $1,000 gap that we have between the $3,000 and the $4,000. And we just buy a little insurance policy so that if you are deceased before your spouses, that insurance policy will buy another pension. So you end up having your cake and eating it too. You end up having the $4,000 a month higher pension. You're actually paying some money towards a life insurance policy so you can have that higher amount. But the other thing also to keep in mind, these plans, these whole life insurance plans, are also great vehicles for tax, we call it tax deferment, also a tax diversification strategy. And when you have a pension, one of the things that a lot of people are very aware of, especially accountants, is that this is a ticking tax time bomb, meaning that this is money that you have not paid taxes on. That money is growing, it's sitting in your account ready for you. As soon as you turn on that income, you're going to start paying taxes as you start to take on that income. So this also happens to be a vehicle that can be used for tax diversification. So just to sum up everything here, the pension max, the idea is to go for the higher pension amount, not going for survivorship, and to use an insurance policy to create a future pension should you die before your spouse. Pension maximization. Andrew Berman, Barrier Life. Thank you for listening.